Good afternoon, everybody, and welcome to Tea with a Trustee. You can see people starting to join there. Ooh, excuse my computer. Just give people a little while to join. They're just clicking up. My name's Susan McFarlane. I'm Head of Marketing Communications and Business Development at Dalriada Trustees, and I'm here to help David Fogarty and Jessie Wilson run this session. I've got a few people there, so I think let's just kick off because it's a half-hour session as always for Tea with a Trustee. We have, as I mentioned just now, just in case you're just joining us, we have Jessie Wilson and David Fogarty here to present the topic today, which is ESG and what should trustees be talking about next. So it's a hot topic at the moment. COP26 is just around the corner, but we'll be focusing on what should be on trustees' agenda and how to cut through the noise and focus on what really matters. The session is going to last around 30 minutes. And if you have any questions, please do put them into the Q&A box or into the chat box on your screen, and we'll monitor them as we go on. We are recording the session, and I will be posting a link to that tomorrow, and it will be sent out to all attendees and anyone who registered but could not attend also. I'll be posing the questions to David and to Jessie throughout. So I'm going to hand over to them just now to introduce themselves. So Jessie, would you like to go first?
Yeah, thanks, Susan. So hi, I'm Jessie. I'm a professional trustee at Dalriada, and I'm also an investment specialist here. And through part of that role, I worked alongside David in drafting the ESG policy that I'm sure we'll talk about as we go through this session. So prior to Dalriada, I spent over a decade working in the investment management industry. I worked as a relationship manager, working with institutional clients in the US. And it was really there that my passion for ESG kind of began. Prior to working there, ESG had always been like a really small subset within an investment exam somewhere, where it was kind of a throwaway comment. But when you actually started speaking to people who were doing the job day in, day out, and you realize the real world benefits of that, both from a risk reduction perspective in investing, but also from an opportunity to put capital in a way that causes a positive impact, it just made a lot of logical sense. So it's an area that I'm really passionate about. So I'm very, very delighted to be having this conversation with everyone today. And with that, I'll pass over to David.
Yeah.
Hi, good afternoon, everyone. David Fogarty, also an accredited professional pension trustee, director at Dalriada with responsibility for investments. I've been here about nearly 2 years now. And prior to that, I was an investment consultant. I'm an actuary by background. I'd probably be the first to admit that, prior to having a trustee role, ESG was very much on the sidelines for me. It was a sort of an additional sort of thing to consider. Whereas I think partly because of the climate and I don't mean the climate with the big C, the climate with the small c, and the amount of kind of topical conversation that we've all been part of for the last kind of year or so, and also now taking on this fiduciary role, which I think is a much more sort of like responsible role, no offense to all the consultants, than being a consultant. ESG has become something that's absolutely core now to my thinking, and certainly one of my determinations in the things I'm doing as a trustee is to make sure it's fully integrated into our thinking. And hopefully Jessie and I can give you a sense of that over the next kind of 25 or so minutes.
That's great. Thank you both for that. So I'm going to kick off with my first question. So really, there's a little bit of a statement, but over the last few weeks here at Dalriada, we've released our own ESG policy. So David, could you perhaps tell us why we chose to do this?
Yes, of course. So, ESG, responsible investment, has been an important issue for Dalriada long before I got here, and we were an early signatory to the UN PRI. I think we continue to be the only professional trustee firm who's actually a signatory to the UN PRI. But things have sort of taken a kind of a tick up in the last, I guess quarters, nearly year. And the board have been discussing kind of ESG in the context of ourselves as a firm and how we behave. And of course, then, you know, the natural thing to do is think about, well, it's not just what we do as, you know, as a business. It's not just in terms of how we operate with travel, electricity, all those other things. It's actually the decisions we take. And being a trustee, and in particular across a significant portion of our portfolio, we're sole trustees. So we're really the decision maker. And it came home to us very clearly that we needed to have a firm view, and we needed to have one that all our trustee representatives could kind of depend upon. It was like, you know, it wouldn't be acceptable for us to be taking, you know, quite different stances in different sort of client situations. So we were determined to come up with that firm view, and then started the process of kind of engagement across the firm. I was asking ourselves questions like, you know, is the regulatory standard enough? Do we need to do more? And to which our conclusion was very much yes. We wanted to set the bar higher. We are a professional trustee. We want to make sure we're doing the right things, not just what the law requires us to do. We also had to ask ourselves a question about, you know, the practical issues. Do we sort of, you know, put smaller schemes to one side because of governance burdens and costs? And to which we said no. We thought all members are exposed to the same risks and potentially the same opportunities, regardless of the size of schemes they're involved in. So we thought it was important to bring all schemes into the fold. And taking all that together, then what we thought was important, despite its challenges, was to put a stake in the ground, to come up with some form of words and policy which we could actually aim and head for. We know there are challenges, and we'll talk about them, I guess, a lot over the next sort of 20 minutes or so. But we thought that putting down a form of words would be a powerful first step in us actually making a difference in the decisions that we take. So that's the sort of broad reasoning. I think Jessie's going to give a bit more detail on what we've actually said.
Yeah, so at a very, very high level, we've just laid out that we expect all our investment managers and other investment providers to really factor in high levels of environmental, social and governance factors. We also think that it's very important when we're looking at schemes, or consider it from a sponsor covenant perspective as well. You know, this will be a potential major risk for employers over the coming decades, and that really should be factored into what trustees' conversations are. And then finally, it's not all outward looking. At a firm level, we very much expect the same high standards of ourselves. And over the coming period, I'm sure we'll be releasing what we've been doing and thinking about internally on that. I mean, Susan is on the call, leads what we do from an environmental standpoint as well. So it's very valid that Susan's here for this conversation today as well. Now on the policy, the one thing that's very measurable and a point that we factored in is our carbon reduction targets. So just to spell out what those are, so we've looked for a 25% reduction in carbon emissions from our portfolios by 2025, a 60% reduction by 2030, and net zero by 2040. You know, from our view, you know, there is the ethical questions around this, but if you look at things from a purely fiduciary standpoint, you know, ultimately, it's clear that the real world economies are about to go through a major transition. So we actually see for schemes a major risk through overexposure to this areas of the economy. And therefore, we want portfolios to gently transition across to reflect the shift that we'd expect to see, or slightly ahead of the shift you'd expect to see. We see this as a really important risk reduction factor that we want to ensure is in place across the schemes that we represent.
Thanks, Jessie. And should smaller schemes be thinking about portfolio carbon reduction targets, or should it just be reserved for the larger schemes?
Yeah, certainly. So currently, as David implied earlier, the current regulation TCFD is impacting larger schemes, and within that regulation, you know, explicitly says that it sees climate change as a financially material risk to schemes, and yet the regulation is only hitting larger schemes, which seems kind of not quite right. So our policy is very much considering this as a risk for all schemes, and therefore we want to make sure it's factored in accordingly.
Okay, and we've got a couple of questions that have been submitted from viewers today. The first one is around measurement, and it's quite a challenge. That's one of the challenges that we're starting to undertake in our own business and looking at our own kind of carbon accounting. But how do you measure it all? I mean, have schemes generally baselined carbon footprint measurement yet to help them facilitate target setting for reductions? David, can you say on that?
So I think the answer generally is no. I think even those schemes that are in the larger than 5 billion camp are still sort of working through the question of metrics and baselining. And certainly this is something we talked quite a bit about in forming our policy, this choice about do you measure where you are first and then set a target, or is it kind of like, is it naive to set a target without knowing where you are now? And we felt that the danger with the former stance is that just time will pass too quickly, and there won't be enough action, and there won't be enough, there won't be enough urgency, not just in terms of how we act as trustees, but the pressure we put our consultants on, the pressure we put our investment managers on, that just won't be urgent enough if we're sitting back. And we took the view that although the data, is very patchy, that it's better to start now. So, and I think there's shades of sort of similarity here with some of the experience the industry's gone through with voting and engagement. The investment management industry wasn't really ready to be able to give that information to trustees. They're being kind of pumped and primed to do that, partly through working through the larger schemes on the way down. And our hope and expectation is that the asset management industry can really move quickly to be able to give trustees of all size pension schemes information about some of the various carbon metrics. And I think the industry will sort of, it will migrate to probably 3 key measures, and I won't go into them now, but will migrate towards there. And I can see a picture emerging whereby asset managers who respond and provide that information as a matter of course, and investment consultants who help trustees to combine that across their asset portfolios, they're the ones that will have a favorable competitive advantage. And I think some trustees, and we're not necessarily in the camp of saying we're going to be kind of we're going to be too hasty with some of these things, but I think trustees and us as a professional trustee, we will be pushing hard. We'll be looking to make sure that the asset managers we deal with provide that sort of information. Now, coming back to the baseline question, until you have that information, you can't quite do the baselining. So I think there'll be a little bit of sort of working through the detail and maybe establishing a baseline at an appropriate point. Perhaps it could be a year end in 2022. That might be the sensible point, and then you have a reference point for measuring from that point forward.
Okay, thanks, David. We've got a couple of questions coming in, and just to say, I'm going to hold on to those until the end, and we'll come back to you. So don't worry if you are feeling a little bit frustrated. We will come back to them. So Jessie, why would schemes not just immediately disinvest? And is this such a big risk?
So if you go back to fiduciary duty again, and where the risks lie, we need our schemes to have suitable investment options available, and there is an opportunity cost for not being able to invest in certain areas. So very much, it's still a developing area of the market. We'd keep encouraging it to develop and keep producing investment options for us. But for now, we would rather keep our opportunity set as wider. Investments is wider than ESG. You've got to remember ESG is an integral part of it, but it's one part of it, and there's broader considerations. But it's also worth thinking about things from an environmental standpoint, not just from a fiduciary standpoint. And if your view is, this transition has to happen now, you kind of Extinction Rebellion, what they're protesting for, we can't wait because we need to control this right now. Well, we've seen what's happened with the fuel shortages in this country, and our economies just grinds to a halt and there's panic and nothing's working. It's about the transition period as important as anything as well. So I think some disinvestments is good because it creates a sense of urgency for the transition, and moving towards a net zero carbon economy is very much key. But it is that transition period that's very important in getting that right.
I might just chip something
Yep.
in there as well. I think there's sort of like, I think typically when we talk, and most people talk about disinvestment, they're kind of talking about it at a stock level, sort of like, should you keep BP or Shell in your portfolio sort of question. There is a different disinvestment consideration, and that is, should you keep this asset manager product in your portfolio or not? And I think, again, as trustees, we'll be leaning heavily on our investment consultants for guidance in those areas. I think many of the investment consultants, perhaps not all now, do a form of ESG ratings on managers. And one of the things that I think trustees need to be very diligent about is where that ESG score is poor and not improving, then one's got to question whether one should stay with that fund. That's not saying you definitely get rid of it. There's always arguments from an investment point of view about that. But I think that's a question. And I think there's a whole range of other things that perhaps weren't necessarily in our mind 2 or 3 years ago. And that is, as many in the call will be very familiar with, the UK pensions investment sort of space moved a lot in the direction of private markets over the last number of years. And again, that's fine because it presented opportunities that they didn't have within sort of public markets. But the level of disclosure and knowledge about what these investments are doing is lower. And again, we're going to need to have that. It's going to have to rise, because we're going to have the same visibility over the ESG credentials of managers of products that are in the private market as in the public market. And that could change. That could change people's views on some of those as attractive opportunities. So I think sort of, as Jessie says, no jumping to decisions, but an awful lot here to consider.
Indeed. And another submitted question. So can schemes investing in index tracking funds really make much of a difference? I don't know who'd like to take that, Jessie.
Yeah, I'd like to say that. I think that is a great question as well. It's kind of everything can make a small difference. Not every pound has got to make a huge impact. But if you consider, if traditional industry index funds and the money was going into, say, indices which are more carbon aware, you're seeing a significant flow of capital to carbon light companies, and that in itself can encourage change. Now, I'm thinking of, say, public equities on this, but that is a secondary market. So it in some ways, it doesn't fully matter. But if those capital light companies need to raise additional capital, or those transitioning towards net zero are all looked on more favorably, then that is a really kind of positive move. Also, ETFs and passive options, typically they're offered by larger firms that do have engagement and voting policies. So ensuring that those are kind of aligned with what you're looking for is very much important. But all that said, it isn't the biggest place that you'd have an impact if that's what you're wanting to do with your money ultimately. Dave was just talking about private markets. Though it's opaque, arguably it will be the biggest way of directly making a difference and capital making change there. And if you think in the public equity space, actually moving to active management, again, probably has a bigger influence, particularly when it's a long-term active manager that has really engaged conversations and knows companies well. That can really make an impact. So it really does kind of depend what you're trying to achieve with the way that you're investing. But I think there's multiple options, and it's not black and white, like you've got to do one or the other. Think about it within your asset allocation. Think about it, what you're wanting to do. Is it impact or is it risk reduction? And take it from there.
Indeed. And how can you integrate additional ESG considerations beyond the purely environmental? So there's E and there's S and there's G. What about the S and the G?
Yeah, that's the other challenge that we're facing. All we do is talk about climate change, particularly with COP26 down the road. So I would actually extend that to other environmental considerations. So, even water usage, biodiversity, list is extremely long. In social considerations, you've got labor rights, human rights, diversity and inclusion, governance could be board structure, compliance systems. There is a very complex world that we live in, lots of interrelated systems, and it's quite difficult to then distill that into a few key statistics. We're waiting on consultation responses on social in particular coming out from the DWP. We know that this is a huge area of regulation where there's going to be some standards set. But for right now, what we're doing, in our policy, we're now, as we review managers, it will begin to look to ensure that your UNPRI signatures, and that really means that they adhere to high levels of ES and G. Investment consultants will rely on them. They're best positioned to carry out in-depth due diligence. And some are doing, some great work in that area. So trustees will really need to lead on that kind of work. The one challenge is, though, that there's different rating agencies doing quite different things, different consultants doing quite different things, and that muddies the water a little bit. But we didn't say it was easy anyway, so a lot still to be done on the other areas of ES and G.
Indeed.
And I might just chip in on that. And I guess there's lessons here as well with the challenges trustees face with implementation statements. So the sort of the typical statement of investment principles that we will all have seen sort of introduced. I think it was, COVID blurs the memory, but I think it was October 19, where one had to introduce wording around kind of financially material matters. And, we all have to accept the fact that the majority of pension fund investment in the UK is through pooled investments. And a fairly typical approach was to say, well, we can't really set our own sort of policies, therefore we're accepting the manager's policies. And, our view perhaps now is that that's probably not good enough, and that there's a need to actually get the managers to come more frequently, to look the trustees in the eye more clearly, to actually explain what their actual policies are and how they're integrating them into their investment process, and then to demonstrate that on a consistent basis. And we don't believe that level of sort of intensity, if you like, was applied to this the financially material policies, but we think that's absolutely necessary as we embark on a more serious approach to kind of ES and G. And again, I think trustees will need to lean heavily on investment consultants in this space, helping them to sort of help, as they can help trustees understand, which managers, is this marketing guff, and which one is it really that how they do it. And that's a key part of manager research, understanding how they actually make the decisions they make. And then that's got to translate not just across public equities, but it's got to translate across all asset classes. So there's a lot of work to be done here, so that trustees can really understand what it is happening in their portfolios, and reach a conclusion as to whether they're comfortable about it entirely, they're comfortable it's heading in the right direction or not, or they're uncomfortable. And in the cases where they're uncomfortable, then they need to be taking action. Oh, I think you're on mute, Susan. So.
Thank you. So just on that note, if you're not comfortable, how do you cut through that noise and really focus on it? How do you get to focus on what really matters? Jessie,
yeah.
Start, or David?
Okay, yeah, I can take it. I think you need to take a step back, and trustee boards actually revisit these conversations. I know that quite often it's regulation coming through, and it's seen as something that needs to be done in a very busy trustee meeting, which has already got too much regulation and is already too long. But it is go back to basics, have a conversation about what's important with a board. It's a quickly evolving area, so I think trustee knowledge and understanding is particularly important. For those using Dariada that are on this call today, there is investment specialists like myself and David that can support those conversations, and obviously investment consultants are probably extremely experienced in that, so do challenge them and question up there. So I think it's just making it really simple and having a conversation about what do you believe in, what really matters. And as an overlay to that, I think it's hugely important as well to look at companies' own sustainability objectives and environmental outlook and social commentary. It would make sense if the pension scheme is aligned with a company which is really hot on all this stuff to also incorporate it in your investments as well.
Yep. Okay. And how do you get the right conversations happening as a trustee? How do you get that discussion going?
Yeah, well, like I think you have to create the space for it. That's critical. So, and it maybe goes back to the comment I made at the very beginning that, certainly a few years back, to me, this was a sort of an afterthought, something that was sort of a feature of trustee training rather than trustee decision making. So I think we need to kind of get to a position, it's probably a long way to move from where we were, but where you're nearly asking yourself the ESG question on everything you do. Are there implications? And obviously, we talked a lot about, we talked a lot about investment here, and I'm pretty confident that from a materiality point of view, that's the most significant thing. But trustees, I think, also need to think about other aspects and sort of how all their advisors and suppliers and behaviors have consequences in terms of E, S, and G, and that's certainly something that we as Dariada focus on in terms of how we're looking to develop an approach and a set of principles for us internally. I think that there are a number of benchmarks externally. So we talked about the UNPRI. There's the UN Global Compact. You want people to be committed to various things that are sort of are clear and written down and can be in a sense audited. And I think that can help. And maybe linking that a little bit to the back end of your previous question. I do think you do need to sort of again, I'm not a fan of, sorry, jumping around the place here. I'm not a fan of belief sessions, as an example. So I think it's you're too far away from the decision making. I would prefer to spend time talking with my consultant about, portfolio. Where's my biggest asset exposure? What do I think about ESG with the biggest one? What do I think about with the second biggest one? What do I think about with the third one? Try to identify whether there are any hotspots and then focus on them. And every time you focus on something, you'll learn more about it and you'll learn better how to engage on the topic. But you start with the things that you think are going to have the biggest impact, rather than having 2 or 3 meetings where at the end of it you write 2 pages of text on your beliefs. I don't think that moves you forward.
Okay, I'm conscious of time. We're nearly at the half-hour mark. We've got 4 questions that have been submitted. I'm going to run through them a little bit quickly. So we've got one, the first one that came in was basically saying, the issue for small schemes, how do you collect and interpret emissions data? It's complicated and time consuming. And how do small schemes do that effectively?
I think that's the biggest challenge facing us. The hope is that the industry begins to change because asset owners all collectively start speaking out for this data. So we will see standardization. So this will start by driven by TCFD. So requirements are already hitting investment managers to be reporting this data. And then over time, as more and more individuals need to report on it as it goes through the schemes, that impact continues, kind of trickle down effect. It's messy, it's muddy waters at the minute. But if we keep speaking for it, we hope it flows through. I've got a vision of you get performance data, you get risk data, you get ESG data as part of reporting that comes through. I think we're a good way off that, but let's keep asking.
Second question is basically in terms of timescales that have been set by trustees for reaching net zero, how important is the role of collaboration? So especially for smaller funds in investing, invested in pooled funds, is it vital that the trustee and the manager horizons are aligned?
David, you go.
Yes and no. Like, I think that I think they will naturally end up aligned. You know, I think sort of Paris in 2050 kind of gives you this kind of mark out there. You know, I think that the world seems to be realizing that you've got to drag yourself in advance of that rather than point towards that. I think it's kind of quite relevant, and if you've been through this discussion as a consultant or a trustee, you probably got this point already, but if you haven't, it is quite important to recognize that this is the majority of assets we're talking about here are DB assets, and it's an environment where we're having a maturing, we're having the regulator looking for, you know, lower risk targets in the sorts of timescales. So there's a natural sort of there's a natural move towards very low risk assets that's happening over this time frame as well, which perhaps means that a target at 2040 is not as challenging as it might at first kind of appear. But coming back to the key question, you know, I think it's kind of, you know, if the managers don't align themselves, then I don't think they'll be selling those products. I think that's probably the reality, because I think the trustees will end up focusing on targets such as the one we've set, and then they'll only be happy to work with asset managers and other organizations who are, you know, behaving in a consistent manner.
Indeed. And you touched a little bit on just talking about the fact that we're mainly concentrating on DB here, but the next question is asking, do you differentiate between DB and DC pension schemes and what your expectations are for a responsible investment?
I think it differs for a number of reasons. Obviously, you've got considerably different asset allocations and different time horizons. So just under those factors alone, and the ability to the fee cap with on DC, for example, as well, it means that you've got very different challenges and expectations around that. So I'm just noticing time here. I might know that we're a bit over. So, you know, the fundamentals of ES&G are the same, but how you think about it at strategy level will be driven by all those factors.
And just finally, a comment, but I suppose more than a question, just somebody said that they were surprised that there'd been no mention made of executive pay in relation to governance. So asset managers and asset owners have been working on it for a number of years, and we haven't made mention of it today, I suppose.
Yeah, no, I'd completely agree. So sorry, I didn't mention that within one of the governance subsets. Executive pay is key. Quite an interesting conversations are happening at the minute about whether some pay expectations should be linked with climate objectives and what companies are doing. So I think it'd be really interesting to see some progression on that, because traditionally the pay conversation tried to keep people away from short-term goals so that they can manipulate the stock price and get a great bumper pay, where you'd rather have exec pay aligned with long-term value creation goals, which is good for the company, good for minority shareholders. It'd be really interesting to see how that develops. And I think actually, if climate becomes a factor in exec pay, I think it could be really interesting.
Okay, well, that's all our questions, and we're kind of out of time now. So David, do you want to just sum up and finish us off?
Yes, of course. So thank you all for attending. I know we've run over by a little bit, and actually by the tone of the discussion, I think we could probably gone on a lot longer. So I'm sure we'll have future sessions on this. It's an evolving area. We think, although the time scale over which we're talking about is relatively long, the need for action is relatively in the near term. And we believe that for members' security, for their pensions, and indeed for thinking about the world in which they're going to retire into, that it's important that these issues are addressed in the near term. There are risks, I think we all can kind of understand the risks. There are also opportunities here, and therefore we think it's important that trustees kind of focus on them, and we look forward to talking to you all at future dates about this topic, and seeing how we can kind of develop as an industry and move the needle forward. Thank you very much.
Thanks everybody for attending, and see you again soon.
Bye-bye.
Bye.